If you're over trading, try adding these restrictions to your trading plan. Stick around. Hey guys, warm welcome to you. Thank you for joining me. All right, so this video is sponsored by Core Spreads Australia. There's a link to them in the description below. Go and check them out. Go and check out their Core Trader 2 platform. Go and see how tight some of their spreads are on the markets you trade. If you're in the market for a new broker, go and check them out. There's a link in the description below, as I said. So if you're over trading, this is probably one for day traders. We've all been there, we've all done that. We're trading stuff that we shouldn't be trading. And in reality, if you cap that over trading, or if you at least made some dent into the damage that it potentially does, you probably find your P&L at the end of the quarter, the end of the year, is going to be far, far better. Regardless whether you're losing at the moment or you're making money, you're going to have far improved P&L if you can get rid of over trading. So I've got 4 things for you, simple things to do. We're not overcomplicating it. We don't have a massive list here, just a simple list that you can perhaps implement if you choose to do so, if you think it fits in with your plan, you think it fits in with your goals, etc., that may well stop you from over trading. And if you can have a little impact on that, then it can have a big impact on your bottom line, or potentially a big impact on your bottom line. All right, so let's go to the first one, guys. Volatility/range filter. So I'm going to assume that most people do better during reasonable volatile conditions or reasonably high range conditions. And there might be a point where it goes too much. If it's too volatile, maybe the performance starts to deplete, because if it's really swinging around, then sometimes it's hard to get a read on it. But most of the time, it's the quiet markets that cause us to take trades that we shouldn't be taking. So an easy way to combat this is to literally have a daily chart of all the markets that you trade. Let's say you like to trade the NASDAQ, crude oil, gold, silver, Euro USD, whatever the markets you have an ATR function set on 1, which is quite an easy way to get the daily range, or an ATR function set on 10 if you want the average. In fact, an average is probably better if you want to get the only thing with an average is sometimes it takes a while to catch up, so you might miss a few days, but ultimately it's up to you. You can adjust and dial it around. You understand how these averages work, guys. You just take an average of the range of the past 10 days. You've got it set on 10 or 14. You've got it set on 14. But the point is that however you choose to do it, the point is you can set a limit for the level that must be a minimum daily range to be done in that instrument for you to trade it. So for example, you might say, hey, I like to trade the Dow, but it must have at least 150 point range for me to be putting it in my trading radar, if you like, or be allowing to trade, or even looking for setups. Now, I'm not saying you've got to definitely trade it, but what this does do is it stops you from getting involved when it's doing 50, 60 tick range in a slow market, choppy market, summer market, holiday market, whatever it may be. Same with all the other markets. You can have exactly the same thing. Now, bearing in mind, you're going to have to understand the intricacies of the market you do this with, because some markets will be different kind of range, which are good ranges. Some markets are going to be obviously different increments, different values. So you have to know yourself. You might like, hey, crude oil, I need at least $2 range on crude oil, or $3 range, or even stricter, you might want to have more. But this stops you then, if you've got a very, very distinct rule, it basically stops you from just getting involved in stuff that you shouldn't. Because it's a golden rule. It's like, hey, the volatility is not high enough. My edge is not here. I am not going to risk my hard-earned capital when my edge is not at its best. So that's the first thing. The second thing, again, filter process, price zones. So what I mean by this, so for example, are we still on the board? We are. Let's imagine we say to ourselves, right, you know what, I am not going to get involved unless price gets into or breaks one of these zones. Now, what this stops you from doing is it stops you getting involved when price is sitting here and it's just doing nothing. You've got no edge, you've got no strategy, you've got no setup, nothing going on. However, you can say, right, this is what's happening to the market. Maybe it's a daily chart, maybe it's a 60-minute, whatever. If the market starts to push to the upside here, I'm going to look at it. Now, I'm not going to say I'm going to go long or short. Maybe I'm going to take a breakout, maybe I'm going to take a fade. I will look at that at that point in time if I can't make a decision now based on the prior price action. But what it stops you from doing, it stops you from getting chopped up in all this nonsense here, again, which is often a magnet for the overtrading. So having some price zones where you only get involved, or you only start to get involved or look at the markets when they're there, is a good filter to have. Okay, number 3. Time of day restrictions, very useful one. This trading the open tends to be the most volatile and the most opportunity, and the close, and maybe lunchtime is too quiet. Or if you want to still trade lunchtime, you say, hey, mean reversion only, no trend trading, no momentum trading during lunch. You can start to add filters and kind of direction, if you like, based on the time of day. So that's a really good way of doing it, especially if you're day trading a specific market. Okay, number 4, number of trades limit. So all of these work in tandem to help you with this one, because this one is something that it's actually quite hard to implement straight away. So if you've been very active in the markets, let's say you've been taking 20 trades a day, pretty active trader, you're scalping in and out, and you think it's too much, you're getting caught up in stuff. So you start to restrict things with a range filter, price zone filter, time of day restriction. Now, the good thing is these will help you bring this number of trades down, because you're probably in a situation where actually, fine, if the market is very, very active, there's a lot of volatility, a lot of range, 20 trades might be great. But you're probably in a situation where actually you probably want to bring it down. Maybe you want to bring it down to 5 trades, 5 good trades, trying to find some decent moves, some decent swings. There's probably, 2 or 3 a day. So if you're saying 5 trades, it allows you to miss a few, get a few, etc. So what you want to do is you want to start to bring the number of trades down. I never recommend going from, let's say we're using that number as 20. I mean, that's quite high, I understand that, but let's use that as an example. You're doing 20 trades a day. Don't go down to just restricting to 5, because the impact that will have on the way you trade will be too much. Start to come down a bit. So what's my average? It's 20. Right, I'm going to do 15. Next week I'm going to do 10, and bring it down slowly. And what that does is, let's say you get now to a point where you've got 5 trades max in the day, and you've come from 20. I think 5 is probably a bit too much, maybe, but let's use it as an example. You do 5 trades per day, you come down from 20. What that does is, let's say you've traded 3 times at the open. You've got an opening drive, you've got a fade, maybe you've got a stop out, but you're up on the day in the open. Now you get another setup that looks okay, it's not great. You start to think, well, if I take this trade, that's my 4th credit, so to speak. It means I've only got 1 credit, 1 trade left to take in the evening, or even at lunchtime if I get a decent setup there, if I get some kind of extension that I want to fade. So you then start to think a little bit more carefully about using up those trades, because you say, hey, I always want to have 1 in the bank because I might get a close that actually is conducive to one of the setups I like, some kind of drive or whatever, or I might get something, the market might suddenly change conditions and start to go really, really active and really decent, and I haven't got any trading credits left. So you start to then be a little bit more careful, and what that does is, when you're mindful that you've got a restriction on the amount of trades you can take, you take a little bit more care, and that's all it needs, a little bit more care to think about the trade that you're taking. Where's the risk on the deal? Where could this trade go? What's the risk-reward ratio on this trade? What's the probability of success? All these kind of things. Is this the trade I want to be taking? Is this the trade I want to be risking my hard-earned capital on? And number 2, using a credit up, a daily trade credit up on. And you start to then become a little bit more mindful, not just click, 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 constantly trading, over trading. And especially if you add these restrictions in as well, and that you can start to bring that number of trades down, be a bit more careful, more thoughtful about when you're going to risk capital. All right, guys, don't forget to check out our channel sponsor, Core Spreads Australia. Links in the description below. Take care. Bye-bye.